Welcome to The Explainer. I'm absolutely thrilled to have you here today. We're going to navigate through the complex and honestly sometimes wildly surprising landscape of energy-efficient equipment upgrades. I want you to think of the modern HVAC market, whether you're a homeowner or running a business, as this giant, sprawling financial maze. If you take the right path, you can unlock incredible government incentives, massive tax write-offs, and brilliant financing structures that totally protect your cash flow. But if you take the wrong path, you might just find yourself tracked by predatory contracts and hidden real estate encumbrances that can literally bring your financial goals to a screeching halt. So today, we're going to navigate this maze together. Okay, let's dive into this with a question that might sound a little dramatic right off the bat, but is terrifyingly real. Could a free or incredibly cheap air conditioning upgrade completely block the sale of your home? I mean, you'd think upgrading your home's energy efficiency would only add value, right? Well, as you'll see, the shocking reality is that residential, door-to-door HVAC deals can secretly encumber your real estate, leaving you holding the bag for tens of thousands of dollars when you actually go to sell. So, here is our roadmap through the maze. We're going to start with the universally beneficial energy upgrade boom, then dip into the hidden traps of predatory property liens. After that, we'll shift gears into the commercial side, with business equipment leasing, maximizing tax benefits, and finally, wrap up with commercial PACE loan programs. Section 1. The Energy Upgrade Boom. Let's start with the easiest, most rewarding path in our maze, legitimate federal incentives driven by the Inflation Reduction Act. The government is putting serious money on the table because they actively want you to upgrade to high-efficiency, climate-friendly systems. And this brilliantly illustrates the two distinct paths here, based on data from Lennox, who are huge players in energy-efficient climate control. Looking at the 25C tax credit, it's universally available, literally no income limits. You can claim up to $2,000 annually for installing qualifying equipment like a heat pump. But then, look at the HEPRP rebate, the High Efficiency Electric Home Rebate Program. This one offers up to a staggering $14,000 in rebates. But there's a catch. It's strictly income dependent, and it scales down until it phases out completely for households making over 150% of the area median income. But here's the trick about the financial maze. The government doesn't just automatically hand you the cash. You've got to know exactly how to claim it. To get that 25C tax credit, for instance, you have to file IRS Form 5695. And to do that successfully, you absolutely must provide a QMID, or a Qualified Manufacturer Identification Number. As an example, if you install Lennox equipment, their specific code is L7S0. If you don't use those specific manufacturer codes when filing your taxes, your credit could easily get held up. It's a tiny detail, but in this maze, the details are everything. Section 2. Beware the property lien trap. Now we have to pivot to the much darker corners of the market, where predators basically follow the demand. This is where we run into these free or low monthly payment leasing schemes that get aggressively pitched door to door. Let's walk through the exact mechanism of this scam step by step. First, a smooth-talking salesperson pressures a homeowner into signing an HVAC rental agreement, promising absolutely zero upfront costs. Sounds great, right? Well, step 2. Hidden deep in the fine print is a clause that allows the company or their third-party finance partner to register a notice of security interest against the property itself, basically a lien. Step 3. Years go by, and the homeowner goes to sell or refinance their house, totally unaware this lien even exists. And finally, step 4. To clear the title and close the real estate deal, that homeowner is forced to pay a massively inflated buyout fee. It's wild. Just listen to this quote from Dennis Crawford, a lawyer who fights these exact practices over at OntarioHVACScam.com. He says, they are shocked when the finance company sends the payout statement demanding payment of $10,000, $15,000, or even more, all to buy out a rental contract for an air conditioner, the retail value of which is no more than $2,500. Yeah, you heard that right, paying $15,000 to buy out a $2,000 unit. The math is completely absurd. And you know, this isn't just theoretical. There are real-world stories, like a homeowner named Taylor Wild who discovered a surprise $11,000 security interest right before selling his home. He had to scramble to pay it off just to close the sale, which literally jeopardized the down payment on his family's next house. The lien stays with the property, effectively holding the homeowner hostage. Now, I want to be super clear here. Leasing your HVAC system is not inherently a bad thing. Legitimate leasing absolutely exists and can be a fantastic financial tool. Take programs like the Service Experts Advantage program, for example. They offer $0 down, they cover all the maintenance parts and labor, and they only run a soft credit check, so it doesn't even impact your score. But most importantly, reputable companies like this are focused on your worry-free comfort. They are not secretly placing predatory property liens on your home's title. The key takeaway? You have to read the contract and know exactly who you're dealing with.
Section 3. Business equipment, lease or buy.
All right, let's transition out of residential and into the commercial world of HVAC fleets and heavy equipment. If you run a business, do you lease or do you buy? Now, what's really interesting about this slide is how sharply it contrasts the two IRS classifications. As our source, Dimension Funding, points out, this isn't just about your monthly payment. It completely dictates your business's tax strategy. With an operating lease, it's a true rental. It stays entirely off your balance sheet, your payments are fully deductible as a business operating expense, and you just hand the equipment back at the end of the term. On the flip side, a capital lease or equipment financing means the IRS basically says you own it. It goes on your balance sheet as both an asset and a liability, and you retain ownership while recovering costs through depreciation. So why might a massive private equity-backed HVAC company choose to lease their entire fleet of service trucks rather than just buying them outright? Well, according to Merchants Fleet, the shift toward commercial leasing is huge right now, and the reasons are brilliantly operational. Think about it. Buying 50 upfitted service vans ties up a massive amount of cash. Leasing preserves that capital for strategic acquisitions or hiring new talent. It also forces a really consistent vehicle replacement cycle, meaning your technicians aren't out there driving breaking down jalopies. Plus, it standardizes the vehicles across all your branches, which streamlines training and gives you totally predictable monthly expenses.
Section 4. Maximizing business tax benefits.
But hey, what if you actually want to retain ownership of your assets for the long haul and you need to aggressively lower your tax burden? Well, we have to follow the money into the complex tax codes that can completely change the math for profitable businesses. $2,500,000, that is the 2025 IRS Section 179 deduction limit. And actually, that rises to over $2.56 million in 2026. What does this mean for you? It means a business can finance equipment, take ownership of it, and elect to expense the entire purchase price up to this limit in the very first year it's placed in service. You don't even need to pay cash up front to get this deduction. You could finance the equipment over, say, 60 months, but take the massive tax write-off on day one. And honestly, it gets even better. Thanks to the One Big Beautiful Bill Act, or OBBBA, 100% bonus depreciation has been fully restored for qualified equipment placed in service after January 19, 2025. The way it works is you apply Section 179 first, and then you layer bonus depreciation right on top for any remaining eligible basis. So to put that into perspective, if a profitable business in a 35% tax bracket finances $100,000 in heavy equipment, they could potentially slash their tax bill by $35,000 immediately. Meanwhile, their actual cash outlay for the loan payment that year is just a tiny fraction of that. It is a phenomenal wealth-building tool.
Section 5. Commercial PACE loan programs.
Okay, let's move to this final section and see how this builds into specialized local government financing. What if you own a massive commercial property, like a factory or a 50-unit apartment building, and you need a multi-million-dollar retrofit, but you really don't want a traditional bank loan? Enter PACE, Property Assessed Clean Energy. We'll look at the Brazos County, Texas program as a prime example here. PACE is specifically engineered for commercial, industrial, and large multifamily properties. It provides up to 100% financing with little to absolutely no upfront cost. But here is the genius part. The repayment isn't a traditional loan against the business itself. It's secured by a voluntary property assessment. That means the long-term debt is tied to the property title, so if you sell the building, the remaining debt just transfers automatically right to the new owner.
So, the crucial point is how these programs mathematically protect the property owner. To even qualify for a PACE loan, you must prove a savings to investment ratio, or SIR, strictly greater than 1. What this means is that an independent engineer has to certify that the projected utility savings from your new chillers or your solar panels will literally exceed the cost of the loan assessment over its lifetime. The upgrade mathematically pays for itself through the energy savings. It creates positive cash flow from day one, and it doesn't even touch the municipality's public funds. It's an incredible win-win-win for the business, the environment, and the local government.
Wow, we have covered a massive amount of ground today, navigating from the universally beneficial paths of residential tax credits all the way through those terrifying traps of predatory door-to-door liens and right up into the heights of commercial fleet leasing, Section 179 tax codes, and PACE programs. And it all leads to one final, vital question you have to ask yourself. From hidden real estate liens to massive tax write-offs, are your equipment financing decisions actively building your wealth? Or are they quietly draining it? I highly encourage you to go review your own HVAC and equipment contracts today. Read that fine print and make absolutely sure you are on the right path in the maze. Thank you so much for joining me on this explainer, and I'll catch you next time.